Hi traders, welcome to this edition of Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we go through the key events and drivers of the markets currently. Whilst I'll just let you have a quick look at the disclaimer. We'll go through the usual format really for the webinar. So we'll just check out where markets are currently kicking off the week. We'll also then have a quick debrief actually on last week's tech earnings, focusing on Meta specifically, really just as a highlight really of the this divergence that we've seen recently between the old world stocks, if you like, and the sort of new world stocks, the contrast there, the divergence in performance between really the Dow and the Nasdaq, and then just these tech earnings highlighting positivity, if you like, in other earnings which probably haven't been the focus of certainly some of the headlines so far, which Meta, Amazon and their sell-offs have certainly grabbed those headlines. We'll also then look at some of the technicals around the Wall Street indices, so the S&P and the Dow and the Nasdaq, just to look at some certain levels there, support and resistance levels. We'll then follow the standard format. Hopefully you recognize that. We'll review, really it's all about central banks at the moment, last week, this week. A trio last week, so we'll review those, the ECB, the Bank of Canada and the Bank of Japan, and then we'll get into a preview of this week's key events. Obviously the Fed on Wednesday, the FOMC rate decision. We'll also get non-farm payrolls, as it's the first Friday of the month. Every first Friday pretty much, if you remember, is non-farm payroll, US employment data. A key data point for the Fed, of course. And we also get quite a bit of other US data we'll touch upon briefly, as well as then looking at the other central banks, the Bank of England on Thursday and the RBA decision overnight tonight if you're in the UK. Okay, first of all, let's look at what's happening in European markets at the moment, really. European markets kicking off Monday, pretty mixed. Investors sort of cautious really over the outlook for the global economy following these earnings, these spate of slightly cautious corporate earnings reports, really. US futures at the moment, they're trading lower, pretty thin trading at the moment. Obviously, a lot of traders looking out for these risk events in the middle part of the week, Wednesday and onwards, Wednesday, Thursday, Friday, really the key trading days of the week, even with the RBA obviously overnight tomorrow, and also the ISM, actually US data, quite important manufacturing survey data there. That's actually Tuesday. So whole bunch of events. The key risk event, as I say, is the Fed. Wall Street itself finished higher on Friday, actually, registering back-to-back weekly gains for the first time since August. Even as those companies, those tech companies, Amazon, Facebook, Meta, really, Alphabet, disappointed investors with their third quarter results and forward guidance. Interestingly, I think FactSet, who monitor a lot of the earnings reports, they've said that S&P 500 companies have so far reported earnings 2.2% above estimates. And that would actually mark the lowest earnings growth rate reported by the index since the third quarter of 2020. On the flip side, the energy sector is reporting earnings growth of 134%. Just a contrast there, but investors really, they've been watching, we've all been watching these latest corporate earnings, really for signs of higher inflation on the one hand, and then also then rising borrowing costs for many companies as well. Actually, I should say, as the dollar and the strength in the dollar obviously impacting overseas earnings for some of these massive companies. This week sort of quietens down a bit on the results front. I think we get Pfizer, we get Airbnb and Uber reporting tomorrow, Tuesday. And then, of course, we have the big main events, as I've said, the Bank of England and the Fed. So just on earnings, actually, just want to pull up firstly a chart which, just bear with me 1 second, which is the Meta chart. But before I get to that, just generally across earnings specifically, a couple of weeks ago, we had Netflix quite well received, actually, those results. But then since then, we've had those real mega cap tech titans, if you like, Microsoft, Google-owned Alphabet, Amazon, and even Apple as well, although they rallied quite nicely on Friday. But they've all suffered quite sharp write-downs, and then specifically the treatment meted out to Meta, Facebook parent, has been particularly savage. Since Tuesday evening, when its results came out last week, Meta's stock has been punished. It really has, for basically disappointing revenue forecasts, advertising especially a concern, despite Mark Zuckerberg really asking for patience as the social media giant really focuses on its investments and its costs really that are involved in the metaverse. The stock plunged 25% on Thursday, and it's now down. You can see a weekly chart actually, but it's now down 70% year to date. And when we just look at Meta generally, so that means it's underperformed the benchmark S&P 500 since it went public, even excluding dividends. And after Thursday's carnage, actually, just looking at multiples, we don't normally do this, but it's interesting to look at these just to measure where Meta is. So we look at, say, multiples, simple ones really, and then we'd also look at, say, market caps, just to really show you and highlight what's happened to the tech stocks, but specifically Meta as an example. So Meta trades at just over 9 times trailing earnings. It's traded as high as 37 times earnings, little more, just a little more than a year ago. And that compares with the S&P 500 as a whole, which trades at around 18 times trailing earnings. So if you think about it, you know, Meta, one of the most exciting growth stocks that we can trade, really. Great days ahead, potentially. The metaverse, of course, the key issue here. But it's somehow now regarded as weak, that it should only trade at half the market multiple. So 18 is the market multiple. Meta currently trades at around 9 times trailing earnings. And it kind of says to us, if you just look at those multiples, that really Meta should never have been trading so richly in the first place. As regards market caps, if you remember, Meta was one of those $1 trillion companies in the top 5 in the world. It's now valued, I think, at around $670 million. So that pushed it actually out of the world's top 20 largest companies. So really quite a severe fall, a real punishing, really. And it was, yes, just looking at the market cap, actually, it was at one point almost 3 times the size of the biggest US bricks and mortar retailer. That was Walmart. And now, for the first time since 2015, Meta is actually smaller in market cap size than Walmart. Really fascinating then. And the performance really of Meta, you can see here now, it's hit sort of 2016 levels, really gone back to that. And if we look at it compared to, say, the S&P 500, as we said, it's now underperforming that benchmark, even excluding dividends. I think also interesting, if we look at the FANG index, so that is, well, if I just mention it to you, the FANG Index Plus, that's an index which provides exposure to 10 of the world's most highly traded tech companies. FANG Plus, so Facebook, Meta, of course, Apple, Amazon, Netflix, Google. That's Alphabet really, and then a few others. So Microsoft, Alibaba, Baidu, Nvidia, and Tesla. That's included in that index, and that, interestingly, now is since the nadir actually of the COVID-19 sell-off in March 2020. Now the S&P 500 actually is outperforming that NYSE FANG Plus index. So really interesting there. You know, for a long time, investors have worked off the assumption that the FANGs, the big tech companies, would benefit from the pandemic, and certainly they did. But now, certainly investors have fully grasped the fact that they shouldn't now be valued as though the pandemic conditions that we did see are continuing, or will actually continue forever. And this then goes on to this divergence that I mentioned at the start about the divergence actually between the old economy and the new economy. Old economy stocks, those classic ones, value-based, so typically better, perform better due to their stable earnings streams. And that is obviously a contrast to new economy stocks, high growth tech stocks, obviously, that are prone to fears of rising interest rates, rising rate increases for sure, and where their earnings particularly are based obviously on these projected profits further into the future. And certainly as the Fed forges on, and we'll talk about that soon, with its pretty much most aggressive tightening monetary policy cycle in decades, then the future profits of tech firms certainly will be worth far less. And we've sort of been saying that in a roundabout way pretty much over the last few months. Whenever tech is brought up, the sell-off comes in when those treasury yields have gone higher. Can you just, if you could just bear with me 1 second, just got a question here. Just about Meta, actually. I wonder if this is a question saying, I wonder if this is the strongest dip for this stock to aim for the buy. Yeah, interesting question. And I kind of was going to come on to some of that, just that potentially, certainly, you know, we've seen these massive sell-offs, and then there are opportunities to buy these stocks. I think at the moment with the Fed in its tightening cycle, and we'll talk about this supposed pivot, of course, potentially a slowing down in the pace. I kind of stress really that it's just this slowing down, and obviously the pivot originally was the idea that there would be front loading of rates, of course, that we've had, and then pretty much a sharp reversal in that, and even a cutting of rates. But really at the moment, I think the idea the market is gravitating towards, that is pretty valid at the moment, is that rates are higher for longer. That's now the phrase really, whereas say a couple of years ago it was lower for longer, if you remember. Now it's higher for longer. Rates are staying higher for longer because inflation is still elevated, still sticky, still high, much higher than the Fed's target, for example, of 2%, let's not forget. So if we have that in mind, then for sure these sell-offs do look as though they're a good opportunity to buy some of these stocks, and especially Facebook. Now we're at 2015, 2016 lows. So certainly it is a time potentially to look at this kind of opportunity to buy these sharp sell-offs. But as well, just keeping in the back of your mind about these higher rates probably staying higher for longer. That is the theme at the moment. And if that is the case, as I've just said, with tech stocks especially, then when there may be some support for sure, underpinning of support, but to get a strong reversal, then we would have to see the Fed very much easing off these higher rates, and potentially then looking for these cuts, which doesn't look to be happening anytime soon, I would say. So just a word of caution, I think. If we just look actually technically at some of these stocks, there's been some interesting charts. If I just look at, say, Amazon, this is the daily chart. You can see I've drawn, for example, that bearish channel from the August highs from that rally, and then how we just dipped sort of to the bottom of that channel and massively into support, really just below support, the May-June lows there. So again, you're right, potentially there is a possibility of a bounce here. If, say, the Fed does pivot, and we'll go into that in more detail soon, but certainly if they did signal some kind of pivot, then definitely these stocks would be seeing a bounce, and then we'd look below sort of $100 or so, say in Amazon, back to the top of the channel, 114, 115 potentially. If I just look at, say, Google, similar chart around the lows, and that's a 200-week moving average, actually, that thick black line at 93.50. So we dipped, you can see, through that and then pulled back. So potentially, if we do hold this support in, say, some of these individual stocks, then with a Fed pivot, for sure, it's a great opportunity to buy these stocks. But as I say, we're kind of not expecting that pivot to be highlighted too much by Jerome Powell, sorry, on Wednesday evening. We shall see, for sure. Let's now just, if we review some of the central bank meetings from last week, I think first of all, good to look at the Bank of Canada. Some of you might not really look at that, but they sort of sum up the conundrum that many central banks have at the moment. Certainly, it was a shock that they only delivered 50 basis points instead of 75. That took the rate, policy rates from 3.25% to 3.75%, 3.75%. Certainly, the Bank of Canada, they clearly stated that there was an expectation for further rate hikes, that they would be required. But on the flip side, they struck this mixed tone. There was rhetoric surrounding the balance of risk to inflation really being slightly more balanced. And as I say, it's this conundrum that many central banks are facing now. We've kind of highlighted this for quite a few months. This trade-off, really, on the one hand, fighting high, persistent core inflation by tightening policy, and then on the other, of course, this risk of over-tightening amid leading indicators really showing a clear downward momentum to growth prospects. For the Bank of Canada specifically, the effects of earlier tightening are dampening housing activity and household and business spending, while the slowdown we've seen in international demand that the Bank of Canada actually highlighted, that's beginning to weigh on exports. Remember, the Canadian economy hugely depend on its exports and the wider global economies, shall we say. Certainly oil, a massive export in the country, and that is a key driver, as hopefully we all know, for the loonie, for the Canadian dollar. Although actually I should say at the moment, or previously, I'll go into this, but it's been stock markets that have been driving, and the volatility in those that have been the main driver of the Canadian dollar in the last few weeks anyway. Growth for the Bank of Canada, they revised lower. And they expect rates will need to rise further given elevated inflation expectations. But the market, certainly, they jumped on the fact that this could be labelled really as a central bank pivot, with the Bank of Canada really getting closer to the end of its tightening cycle. And money markets reacted accordingly. So they took down that terminal rate, that peak rate in Canadian policy rates in the money markets from a sort of peak of 4.5% to 4.25%. So where we are now, markets only probably seeing another 50 basis point increase by the Bank of Canada. Regarding the loonie, that is the Canadian dollar, that actually did pretty well across the meeting, even though it was this dovish pivot. And as I said, really that was probably down to actually the dollar, weakness in the dollar on the day, and really reflecting the market's view that the bank's decision may signal potentially a shift in the Fed this week. That was kind of why the Canadian dollar probably stayed up after that surprise dovish tilt, if you like. And certainly potentially then, if you look at the major, the dollar CAD that is, then you've obviously got this more hawkish sounding potential Fed contrasting with the more cautious policy approach from the Bank of Canada. And that would then potentially keep pressure on the CAD and for dollar CAD to remain supported, essentially. I just want to touch on those drivers. Actually, as I said previously mentioned, there's been a big positive correlation with the Canadian dollar and US equities. That's kind of softened very recently, but that correlation actually peaked a little above 90% in the last few weeks. And that was the highest on quite a few Canadian central bank, Canadian investment bank measures in recent history. But as I say, that well, it still remains elevated. I think around 70% or so. So don't forget that if you're trading the loonie Canadian dollar, strong correlation with US equities, of course, as well as then the usual sort of oil being a major driver, but at the moment slightly less statistically significant with US equities and the Canadian dollar. For prices on dollar CAD, technical analysis, that is, if we look on the technicals, you can see we dipped down to a fib level. That's of the August to October rally. You can see the 38.2 level at 135 actually on the nose there. Good support. It has been on a couple of occasions actually early October, and then obviously last week, and we pushed up from there. So it's acted as pretty steady support. I think we highlighted this a couple of weeks ago, being these sort of big figures actually conveniently. So 137 is probably resistance. You can see the 21-day moving average of 136.93. Then the next fib level, actually, the 23.6 of that rally is at 136.82. So sort of resistance above around 137, just below. And then you've got strong support at 135. Okay. Next up was the ECB meeting, huge meeting, of course. Let me just pull up the chart. But before we get to the chart, obviously the ECB hiked by another 75 basis points, bringing the total tightening to 200 basis points actually since the inaugural rate hike in July. The ECB depot rate now stands at 1.5%. And really the statement indicated, sorry, I just thought I had another question, but no other questions. Of course, if you have those questions, please write them in the box and I'll try to answer them as we go along, or certainly at the end. And hopefully that will clarify a few things that we see at least. But the ECB statement, so that indicated further tightening ahead. And in the press conference, actually, President Lagarde said that we have more ground to cover. But the market's fixated actually really on the statement and the dropping of the phrase next several meetings. And that was hiking potentially over next several meetings. And that was certainly interpreted as a potential slowdown in the hiking pace. So instead of this sort of more front loading, if you like, that opening paragraph then stressed the substantial progress made by the ECB in withdrawing monetary policy accommodation. And both changes really, they suggest there's no real consensus actually on continuing. So the current 75 basis point rate hike pace in December, at least not for the moment. And certainly then we've had CPI data, if you've been looking at that today, record highs again. way above the 9.9% previously, 10.7% it was expected, 10.3%. So really that will have the hawks crowing probably quite loudly on the wires, you would think, for this bigger 75 basis point hike, potentially following last week's as well, that we potentially get in December. But backtracking actually just after the meeting, the ECB meeting and this potential pivot, then markets discounted actually a slowdown to 50 basis points. Certainly the jury's still out, as I say, in this latest CPI data, along with a lot of the countries reporting last Friday, actually, that has actually then picked up those potential rate hike expectations. Interestingly, we've obviously got this mild winter in Europe so far, pretty much November already, and we've seen sort of very mild temperatures across the Eurozone, really, and that's kind of postponing potentially the day of economic reckoning for the Eurozone. Regarding a meeting as well, we thought there might be some speculation, many did, around quantitative tightening, QT, but there really was no mention of that. The ECB said they'll use the final policy meeting this year, so in December, to set out a broad strategy around that. There won't be a start date, but just a winding down strategy for its 3 trillion euro bond portfolio, that is, which is really the sort of second pillar in the normalization process that we're seeing by the ECB. I think interestingly, just to highlight then, after the meeting, we did see reports indicating the council debated whether to acknowledge actually this substantial progress in normalizing policy, because some officials actually were concerned that it may signal slower tightening ahead. So really interesting there. And it was also reported actually that 3 council members preferred a smaller 50 basis point increase actually. So just always interesting to look at the news wires if you have access to those after the meeting, because officials really, they do like to push back on how the market has reacted potentially to what has come out in the statement and the initial reaction, as I say, immediately after the statement and President Lagarde's press conference. As I say, we've had blockbuster CPI data out this morning, out Friday from the countries, and actually that has pushed the peak rate up again for the ECB, I think now around 2.75%, 2.75%, as I say, back from that 2.6% marker when we had that sell-off after the ECB meeting last Thursday. Going forward, I guess in the medium term, recession is coming to the Eurozone, probably hit certain countries already. And then especially with, you'd think, global growth under pressure, misfiring Chinese economy as well, then certainly the Eurozone, the Euro may struggle in the medium term. If we look at the Euro-dollar chart, which is here, of course, we highlighted it actually on our daily commentaries, if you follow those, and just looking at the charts now, we did have this pop up out of the descending bear channel, that long-term bear channel, really neat series of lower highs and lower lows. You can see I've also drawn in a sort of trend line resistance as well, and we popped up through that last week, and everybody got quite excited really that potentially, you know, we got through parity. That was a key level, and we were going higher. Sadly, pretty much upside capped by that light gray line. That's the 100-day moving average, now sat at 1.0076. Also those mid-September highs around 101.87, you can see there, they kind of capped any upside as well, and we fell sharply, obviously, back down Sadly, after the ECB meeting, the pivot, and we're sort of hovering now around a key level. We've highlighted it for some time now, that 99.52 mid-July support that you can see there, sort of around parity, but really we think that's more important actually on a technical basis, 99.52, and we're hovering just below there and sort of just on that trend line resistance. Is it trend line resistance or support? We've got sort of support just below that as well. If you can see the 50-day moving average, 98.87. And then the light sort of gray line there is the 21-day moving average, 98.42. Acting as support just below. Much will, of course, depend on the Fed meeting for the direction of Eurodollar for sure. Finally, one other meeting from last week. How are we getting on time-wise? We're okay, I think. One other meeting, of course, the odd one out, if you like, kind of. They didn't hike, of course. The Bank of Japan never expected to hike. Stuck with its super uber easy monetary policy. Kept its main rate still at negative 0.1%. Let's not forget, obviously targeting the JGB, the Japanese government bond 10-year yield around 0% with a plus or minus 25 basis point deviation allowed. This is despite actually the Bank of Japan lifting inflation forecasts for the year end, ending in March from 2.3% to 2.9%. But inflation in the 2 years thereafter is seen coming back below 2%, below target at 1.6%. So that really is a sign that the Bank of Japan policymakers there really view the current inflation levels, headline, I think, at 3% in September. They really view these as transitory, just to use that word again. The central bank also grew actually more cautious on growth, revising it lower from 2.4% to 2% for the current year, and then 2% to 1.9% for next year. And in the press conference, Governor Kuroda, he reiterated that monetary policy does not target FX rates. And Japan actually has a history of suffering from a strong yen. And that really implies little inclination, really, that there's going to be any shift in interest rates while he's at the helm. Let's remember, actually, that his term expires April, I think, next year. And a lot of people are kind of strategists, Wall Street analysts, and the like, Japanese experts looking at that time next year when potentially there will be tweaks to the policy, but up until that moment, probably nothing yet, no inclination, certainly from him, that there's any shift in rates. And interestingly as well, the Japanese government actually also announced a new economic package worth $200 billion in support of really the Bank of Japan's inflation quest. And really, in what we've seen for a long time, it's really that divergence between the uber dovish Bank of Japan and the much more aggressive Fed and the US in particular. That's inflicted all the damage on the yen that we've seen for sure. And as long as we get this unchanged dovish policy from the BOJ, then really that will undermine, as I said, the finance ministry's efforts to stabilize the currency. We've kind of said that consistently for some time, and also the fact that unilateral intervention, especially by the Bank of Japan, has been proven to kind of not work over the long term. That said, of course, we do get times, and obviously when we hit 151.94, a week ago Friday, then certainly we get big moves to the downside. But sort of longer term direction of travel for the time being with those policy divergences is for the yen to weaken still against the dollar. And you can see, well, actually, if we talk about the size of intervention, interestingly, I think for the month of October, that's expected to be close to $40 billion. And that follows the 20 billion of intervention in September. So ramping it up, the Ministry of Finance. I think Japan has around $1.1 trillion of FX reserves. So there's no real question of Japan running out of FX reserves, if you like, to continue with intervention. But at the same point, of course, these reserves, they're not limitless. So really expectations are for the moment for FX intervention to continue, but strategically and really in these sort of stealth interventions that we're seeing. So not explicitly calling around desks that we highlighted actually before, but just stealth interventions. I thought we had another question, but just somebody saying hi from Nepal. Hello, good to speak to you. Hope you're enjoying the webinars and all our commentary, and hope everything is pretty much clear to you about what we're saying. Of course, if it's not, please do ask questions. Okay, just on the chart, the dollar yen chart now. We can see, yeah, upwards trend is obviously very noticeable. Probably should draw this box along. Really, this is a key level of support. Actually, just below sort of just around 145. So the top of the band before. You remember the first bout of intervention was when dollar yen hit 145.90. You can see that candle there from the 22nd of Sep. Obviously intervention, but then this edging higher, and then really trying to bump up against that sort of 145 level again, that line in the sand, which everybody sort of thought was a key level, which the Ministry of Finance would defend really, but then we've obviously edged higher. Broke that key dotted line, which is 147.67. That is the 2002 spike high from way back. We kind of didn't think we'd get there, to be honest, from 145, but obviously breaking that, it was a big bust. And then to 151.94, that proved too much for the Ministry of Finance, for Japanese officials. We obviously came back, but the 21-day moving average, you can see there, kind of acting as quite a nice line of support, really. That is at 147.12, just below that 147.67 level. So nice sort of near-term area of support as we push up towards now 149. Really interesting to see where that goes. And then potentially you've got a lot of volatility, of course, if there's then some sort of stealth interventions, particularly in the sort of less liquid times. So be careful of that if you're trading dollar yen. Okay, quickly moving on now to the Fed, the main event of the week. I think, sorry, just bear with me one sec. Yeah, so the main event of the week, obviously, I've got the dollar chart here, but before we look at that, firstly, probably worth mentioning US core PCE data. That's the Fed's preferred inflation gauge that came out on Friday and remained elevated for September, pretty much as expected, but still the core was at 5.1% from 4.9% previously. Well, a touch softer actually than the 5.2. But on a month-on-month basis, gains, well, were flat, but still elevated at 0.5%. Regarding the FOMC then, Fed fully expected to hike by 75 basis points. If I just show you the CME Fed Watch tool, if you don't know this, is just the Fed funds futures rates for the precise meetings for the Fed, what the money markets are pricing in. You can see 75 basis point move taking the target range to 3.25% to 4% from the existing 3 and 3.25%, pretty much 90%, pretty much baked in there. So that's not really the issue. There is the firm focus really much more on the guidance regarding the pace and strength of future rate hikes. And then, of course, what that says in the statement, but also then Jerome Powell's press conference. And just to reiterate again, it's all about this pivot idea. So if the Fed looks to shift to a slower pace of hiking with its expected terminal rates, which is still roughly in the 4.5% to 5% area, and it's whether then they signal that shift or potentially not. I think interesting to point out when or just before the blackout period, so that's the period when we no longer get Fed speakers allowed to speak, but basically 10 days or so before the actual announcement. And we've had this Fed insider, this Wall Street journalist, Nick Timiraos, kind of known now as the Fed's messenger, if you like, the Fed's whisperer. And he's noted that, well, previously he's noted that the Fed is certainly up for this fourth straight 75 basis point hike on Wednesday, and then added that the meeting will be a kind of critical staging ground for future plans, and whether that does then hold out for some sort of step down to 50 basis points in December. And if we just look at what's priced actually for that meeting, you can see it's kind of a coin toss now between a 50 basis point move and a 75 basis point move. So we kind of do have this pivot already in a way. And if we just look at what we did have priced, you can see that a week ago, the 75 basis point hike was actually higher. So above 50 at 55% pretty much. But that's come back now below 50%, 46.8. And actually a 50 basis point hike is slightly more favored, but really it's a coin toss between that 50 basis point and the 75 basis point rise in, remember, in December. So not November, December. And this is critical for what the Fed's Powell is going to say in his press conference. Yeah, Timiraos, so just to go back to him, certainly he highlighted that this was going to happen, and then we've priced out so much that 75 basis point hike, another one, the fifth it would be. We've also had some Fed officials as well. The Fed's Daily gave remarks calling on the need to step down the pace of tightening. And we've had other officials similarly saying other things. I'm just trying to remember the other official, which I can't remember, but will come back to me. But in the meantime, yeah, so we've had Timiraos warning of this potential move and this pivot. And really it's concerns about now actually about the loosening in financial conditions, because we've had the spike higher in longer end inflation levels. And that has obviously been then accompanied by this pickup in risk appetite, this rally in stocks, the fall in treasury yields that we've seen below 4%. We're just above 4% actually, but we got to 4.33% actually in the US 10-year treasury yield that everyone looks at, a widely considered benchmark for borrowing costs. That came off recently. It has from 4.33 below 4%. That critical level. Now we're just above there since this sort of pivot idea. And then we've obviously had the rally in risk assets as well. Obviously, along with that, we've seen then the dollar falling, although now potentially, as we've seen that core PCE data, especially, we've then moved slightly again above 4% in the 10-year treasury, and the dollar is rebounding slightly, only slightly. But again, back to Timiraos, interesting. We're spending a lot of time focusing on him. He very recently, I think over the weekend, though, has come out then with another article, and this goes back to what I was saying before about this higher for longer. This article basically saying that because of the high higher savings buffer in the US and then lower interest expenses, then that could make the Fed raise rates higher and then keep them there for longer. Actually, I think kind of the words he used as well. So a lot of conflicting ideas going on, but Tim Morale, certainly one of the Fed sort of messengers, has been known for. So just something to take note of there, depending on what you've been reading and what your analysis is, obviously, of the Fed as we go into the meeting. I think consensus really from Wall Street is really that Powell does push back against this narrative about the pivot. I think it's probably too early to have any kind of pivot with inflation where it is so elevated. I think there are some calls that he hints, or he kind of front runs in a way, the December dot plot, the updated December dot plot that we get, which may hint at a higher terminal rate above the 4.6% median dot that we got in December. So potentially if he hints that those dots will be priced higher, then again, that kind of stresses this idea about rates being higher for longer. And it kind of is counter the dovish signaling that we've kind of been seeing recently. That means then a reduction in the pace of hiking would, we'd probably backtrack from that even more, and that would underpin support for sure for the dollar. And then if he does row back again, potentially then you have the stock rally easing really, and selling off potentially again in those tech stocks as well. Seemingly a very difficult communication exercise really for Powell, but as we've said, all central banks facing this issue, potentially hiking as growth slightly recedes, but inflation remains elevated. The dollar, we can see just on the technicals, we can see it's pushed off 109.29, that key sort of top from July. Prices oscillated around there through the summer into September, obviously pushed up to the high. This is the DXY 114.77, but then we've just come off that with this dovish pivot and then sort of bounced in the last few days up to the 50-day moving average at 110.92, acting as sort of very near-term support. Then major support around the lows from last week, 109.53, 109.29 area for support. Resistance above is the 21-day moving average. You can see there the grey line, 111.94. We see it, but potentially if Jerome Powell does push back, does hint that the dot plot in December is going higher again from the 4.6% peak, then potentially that helps the dollar rally. I think it's good to look at gold as well. Potentially that will be affected massively by the Fed decision. Trading really quite nervously within kind of a narrow range. But certainly we might get volatility, as I've said, into the Fed meeting, after the Fed meeting. The gold is actually heading for its 7th straight month of declines. That's the longest streak since at least the late 1960s, I think, according to Bloomberg, while bullion-backed ETF holdings, they've dropped to a 30-month low. And also money managers, they hold a net short nearest the highest in 4 years. Interesting stats, I think those potentially has the developments for a potential rebound. Let's be honest, but maybe sticky in the near term, and certainly as we have to reach kind of peak Fed hawkishness, if you like, from when then we see yields come down. And then the dollar soften. Near term, though, really the 1676 level is acting as huge sort of resistance for gold. Try to push up above there and above the 21-day moving average at 1666, but that held cap prices, and we sort of just rolled over yesterday and today as well to kick off the week. So potentially then we aim for the late October low there, you see 16.17, which is also, we've highlighted a key fib level from the 2018 lows up to the highs. That fib level is the 38.2, I think. Let me just go there. Is it 38.2? Sorry, it's the halfway mark, actually, between the 2018 lows up to that all-time high from August 2020 at 2075. So the halfway mark is at 16.17. Acted as support already a couple of times. So a key level of support just below, if we do move from sort of current prices, around 16.37. Right, very briefly, sorry, I'm taking a while here, but also we have the Bank of England meeting. They're expected to announce their decision on Thursday. Money markets fully priced in pretty much a 3/4 point rate increase. Fascinating, I think, really. We had massive speculation, obviously, around the gilt crisis, where for a much bigger rate move, I think markets were pricing in a 1.25% move at this meeting, and even above that, actually, before everything's kind of calmed down. Deficit nerves obviously have calmed down, and the central bank is presumed to now adopt a more cautious stance. But even a 75 basis point hike, let's remember, that is unprecedented as far as the Bank of England are concerned. And also, if you remember, they kind of battled with a half-point rate move, actually, last time and the previous time. So a 75 basis point move priced in by the markets. But key, of course, will be for markets then the minutes, Governor Bailey's press conference, and we also get some updated economic forecasts. So it's a Super Thursday, if you like, because Super Thursday means we get the NPR, so we get these updated forecasts. But certainly with CPI running at 10.1%, I think in September, the core metric advances to 6.5%. Then policymakers, they kind of said that they will deliver a significant rate hike after they adjusted 50 basis points in September, and that kind of underwhelmed some in the market. 75 basis points, that would take the bank rate to 3% from 2.25%. And the decision to hike rates is expected to be unanimous, but there is then expected to be a split in views over the magnitude. So again, quite interesting, I think, important to highlight. DINGRA voted for a 25 basis point hike in September, and also Ten Radio, the potential dissenter as well. But beyond this meeting, then market participants will be on the lookout for clues about further tightening within the policy statement. As a reminder, the bank has continued actually to push back on the aggressively priced market pricings, actually. Deputy Governor Broadbent actually noted not so long ago that it remains to be seen if rates need to rise as much as currently priced in by the markets. And at the time, the peak rate was around 5.25%, and is pulled back to sort of 4.75% now. The market currently pricing in that peak rate. But that implies, if we do get a 3/4 basis point move, obviously that implies 175 basis points of tightening beyond November. Also interesting, I think, even the hawkish Catherine Mann, another MPC member, was recently quoted as saying that markets are too aggressively priced. And I think from the fixed income background that we come from here, it's always known that sterling markets go much further, price in much more than actually then comes to fruition. Obviously, we've seen that over the gilt crisis a few weeks ago, but even now, 75 basis points is a big move. Let's not forget, for the Bank of England. I think the accompanying projections, those forecasts, growth and inflation, they'll be subject to great uncertainty, and may actually be of potentially limited use, given that they can only factor in the stated government policy. And given that the fiscal event on the 31st of October today has actually been pushed back to November 17, then the MPC, let's remember this key point, actually will need to base its forecasts on the energy price guarantee being maintained for 2 years instead of the shorter time frame now that actually Chancellor Jeremy Hunt is expected to officially unveil in a few weeks' time. Plus, of course, the MPC will not be able to factor in the more stringent fiscal package that is meant to be in the pipeline for November, on November 17. That means economists expect the MPC's forecast likely will show CPI inflation hovering near the 2% target in 2 to 3 years' time, despite this big upward shift in market expectations. So again, a really tough spot for policymakers. Inflation in double digits, but the Bank of England already forecasting a recession to begin this quarter. And the latest business surveys pretty much confirm this. I just think then it's worth kind of considering a 50 basis point move. It's certainly, from our point of view, kind of slightly underpriced, actually. If we get these new set of forecasts, which are really dire, so a deep recession and inflation potentially falling below target in the medium term, that then could highlight market pricing being slightly inconsistent, actually, with the bank hitting its inflation goal. And also then a 75 basis point hike, it does kind of set a precedent because it risks being kind of the default move seen by markets. I think really interesting point that, and one to consider, because that's what we've seen with other central banks when they've hiked big, then markets price in then this bigger rate hike, which is potentially not what the MPC want the markets to do, as we've said from some of their some of their comments recently. But also we have to remember, I think 3 members of the MPC, they voted for a bigger hike last time for 75 basis points in September. So it's just something to bear in mind, although you kind of think if the bank wants to retain any kind of optionality for future meetings, then it might not go that bigger step towards 75. I think also interesting for sterling on a trade weighted basis, it's now actually stronger than it was at that September meeting when we had those 3 votes for the 75 basis points. So no, just a few points really just to highlight from our side, really potentially this underpricing of a smaller move, but that would obviously go against probably consensus and against what markets are pricing in for sure. The fiscal update we mentioned November 17 will be key going forward. If we do get this tighter policy, this tighter fiscal policy, but then also more dovish monetary policy, then that will of course be bearish for sterling. If we look at the technicals now, again, bearish channel, a series of lower highs, lower lows, really. And we've drawn in some fib levels there, actually, of that this descending channel. Then the breakdown, obviously, to the low 103.56, of course, and the sort of pop higher, really, just back into that channel, got to the lower end around 110, and then the sort of credibility kind of getting more restored to UK government policy, at least. Liz Truss leaving, of course, Sunak coming in, and then obviously delaying this fiscal statement. Top of the bear channel now, interestingly, haven't got quite as far as the 100-day moving average of 117.25. It was looking potentially as though that could have been some sort of bullish continuation pattern, near term, but we're sort of moving down over 1% now, or nearly 1% actually on the day today. So first level for us would be 114 area, critical area. If we just go back, 114.09 is the pandemic low. So for us, a key level of support now. Along with a 50-day moving average at 113.72. You've also got the 21-day moving average just below there, 113.05 or so. But for us, 114, a critical level of support. And we'll certainly see how things develop after the Fed, of course, on Wednesday night UK time, and then obviously the Wednesday evening, actually, the Fed 6:30, that press conference, 6 o'clock, the rate decision by the Fed. If you're in the UK, because clocks are brought forward, otherwise, then the Bank of England meeting is midday UK time. Okay, a lot covered. I hope you've really enjoyed this webinar. Sorry, I do have, we didn't really run through non-farm payrolls, and we've gone over the hour really, but something to bear in mind, of course, after the Fed, you've got a few figures there for your guide. 200,000 expected, 3-month average around 372. So really job creation still fairly solid. Anything around that 200 mark, 200,000 level would be perceived as still, very acceptable and well above the sustainable pace. Okay, time to wrap it up. Really appreciate your time. Please follow us on social media, and we look forward to seeing you again next Monday. Okay, take care.